Vacancy risk is the silent killer of commercial real estate portfolios. It's not a matter of if, but when. An empty space doesn't just mean zero income. It means a slow drain on your resources that can capsize your investment. To manage this, you must calculate risk using historical data. You can't predict the future, but you can track the past. Look at the last 10 years of vacancy rates in your specific submarket. Identify the downtime averages between tenants. If the average downtime is 6 months every 5 years, that is your baseline for calculation. Don't assume you'll beat the market. Next, calculate your monthly carrying cost. This is the check you write when no one is paying you rent. Mortgage, property taxes, insurance, utilities, and CAM fees. These don't stop just because the rent checks do. Take that total monthly hard cost and multiply it by your market's average time to release. If your cost is $5,000 a month and leasing takes 6 months, your exposure is $30,000. Now, how do you protect yourself? You build a specific vacancy reserve. Do not mix this with your general operating funds. Start with your annual net operating income, or NOI. This is your theoretical best-case revenue scenario. Multiply that annual NOI by your market's structural vacancy rate, usually between 5 and 8%. Take that calculated amount and physically move it into a separate reserve account every single year. This discipline protects your cash flow. When a tenant leaves, you draw from the reserve, not your personal savings. You should also stress test your portfolio. What happens if vacancy lasts twice as long as the average? In a recession, 6 months can turn into 12. Your reserve needs to be robust enough to handle the worst-case scenario. Another layer of protection is tenant diversity. Don't have all leases expiring in the same year, stagger them. Staggering lease expirations ensures that you only ever face vacancy risk on a fraction of your square footage at once. Remember, vacancy isn't just lost rent. It's also the capital costs of releasing, broker commissions, and tenant improvement allowances. Factor these TI costs into your reserve calculation. A new tenant will almost always demand fresh paint and carpet at minimum. Review your risk analysis annually. Market conditions change. If vacancy rates rise, increase your reserve contribution. Stay ahead of the curve. If you see supply increasing in your area, prepare for longer downtime before it happens. This mathematical approach removes the emotion and fear from vacancy. It turns a crisis into a managed expense. Calculate the risk. Build the reserve. Protect your cash flow. That is how professional investors survive the downturns.